want to buy a home in the next 6 months and you're very nervous about finding the perfect place, that's very normal. But the blind spot here is a lot of people realize that when they find a perfect or an ideal place and they assume their financing is going to be okay because they make great income, they uncover blind spots super last minute, which means they lose the home, or even worse, they put their deposit down and they lose their deposit because there's some common blind spots they could not course correct fast enough, and therefore they come out losing. So let's get started so you don't make the same mistake. I will give stories around 3 major qualification factors for a mortgage. Number 1 is credit score. Number 2 is acceptable income. Number 3 is down payment and closing costs. So for the first one, it's having a great credit score according to the free online credit score software, but not going deeper and realizing there are some things between the lines lenders do not like. Secondly, with income, whether you're self-employed or employed, your income may look great from the surface, but the way the lender interprets your income is not what's going to help you. They may disqualify income that you think to yourself, but I make the money. Not every income is acceptable to the lender. And lastly, you may have the money to cover everything, but sometimes the lender says you need to cover with more money, or the way you're generating down payment is not acceptable. Therefore, we want to see more money in your account. These are all things that if you're in a pinch and you're trying to close on a property, it is very rare to figure these out in a quick enough time. So listen up and let's make sure you don't make the same mistakes. Number 1, credit score. So with a lender, a best rate lender wants at least a 600 score. It's out of 900. Most want at least 680. There's only a few who will do 600. And over 720 generally guarantees best rates. Now, let's say you're at a 760, so you're over the threshold. Remember, 760 and 900, you get the same rate. You just got to be over the threshold. So I've had clients who are in the 800s, but the blind spot is 2 things, and that's called having old collections items or having thin credit. So you may have had an old credit card that you thought you closed, but you owed maybe $30 on it. You never got the paper in the mail that says you owe $30, and they quietly made it what's called an R9, a classification that says you did not pay, it took you many attempts. They send it to a collections agency and you're basically blacklisted there. It'll either super decrease your credit score, or it'll be a stain that a lender looks at when they're actually approving you and say, hey, you got to get rid of that. We're not comfortable with your R9. So look out for that. Best way to do it, get an Equifax report and get familiar. Are there any stains on your credit score? Even though it's high, what's the fine print on it? In line with that, what's a thin credit score? Let's say you don't take on a lot of credit cards because your parents said, debt is bad and just use your debit card. You could have an 860 credit score, but if a lender says you don't use credit enough and therefore you don't have a great track record of borrowing small amounts of money and paying it back, i.e. having at least 2 credit cards that you use on a consistent basis, I've had clients where their score is just too thin, so they don't believe you'll be able to handle a higher debt load, and you get penalized for not using credit, which is kind of counterintuitive to what our parents told us, right? So you want to have at least 2 credit cards that you have for at least 2 years, recurrently paying expenses, of course, on time. So these are just blind spots that I've had clients literally at the last minute be like, oh, I don't have that. And it takes a lot of time to course correct. And a lot of people, when they come to the pre-approval stage 6 months earlier, they say, oh yeah, no hard credit pull. We'll do that when I'm ready. So within 1 to 2 months of buying. But they don't realize that when a broker pulls your credit score, it typically does not sink in more than 1 or 2 points, which you get back pretty quickly, by the way. But with us not doing a hard pull and you relying on a free online software, we cannot catch these monumental things or these fine print items that later on will set you back 6 to 12 months, or worst case scenario, you lose your property or deposit. So do not be a credit score perfectionist. Dig into the details at least 6 months before to make sure there's nothing in your credit score that's going to be a red flag beyond the actual score, which is the tip of the iceberg. Super important. I can't tell you how many people continuously come up against this and they have their hands in the air. They can't believe it and they left it to last minute. That's super important, and that in a nutshell are the things you got to consider with credit score at least 6 months before you think you're ready to buy. Let's talk about income. A lender will look at income very differently than the way we as normal people do. You may say they're impractical. Honestly, that's my thought on it. Let's get some examples on some of the blind spots you might have with how you infer income in them. So for example, you're employed. You have a letter of employment, you get pay stubs. One blind spot is if you work part-time, for example, and you make $60,000 a year, unless you've worked part-time for 2 years in a row at that job, some lenders will count that as $0, okay? That's called a variable pay. Likewise, if you make a base salary of, let's say, $60,000, guaranteed hours and income, which is great, but you make commission or bonus, so more variable pay, we need a 2-year average on that to count the commission. If you made $100,000 this year, you had $40,000 in bonus, well, that's just for 2 years. They will not count the $40,000, and that could wildly throw off your pre-approval, which is why going on a random pre-approval calculator isn't enough to capture this nuance, okay? Lastly, probationary period. You could be making full-time salary guaranteed hours, but if you started a month ago and your property closes a month from now, so from day one that you started to when you're closing on your property, it's only 60 days, they need to see 90, so they're gonna count the income as 0. Is that too conservative? I think so. Most people know if they're gonna get past it, but that's the way they think. So your closing date has gotta be at least 91 days after your first day at work, and they'll do the math on 90 days. So that's one example around being employed where you think you have the income, but you don't. As I said, self-employed, all of it's variable income. Typically, you need 2 years average. There are some exceptions if you've only been around for at least a year where they can infer based off your past work that's related. Room for exception, bigger down payment needed. But again, these are counterintuitive ways that your income that you think you have is actually a lot lower, and therefore you don't have enough money to qualify and you get set back 6 to 12 months after you put in a ton of work to find a property. So again, these are simple things we can clarify to make sure that you are prepared, not just when you found the property, but much before, so you have the right strategy. Third, down payment. So with down payment, I had a client who thought they had enough down payment, and in fact, they technically did, but they got some down payment from sources that the lender does not count as acceptable, and therefore they will not advance the mortgage funds at closing date. First example, they got a gift from a best friend. They've known each other for years and years and years. But for a lender, they say, hey, if it's a friend that's gifting you money, they're probably going to want it back. The only people that we believe truly gifted you money without it being a debt, which is bad for your debt to income ratios, are your direct family. Well, what does that mean? Mom, dad, siblings, and sometimes your grandparents. Some lenders say that a grandparent, not close enough. An uncle, not close enough. A friend, definitely not. So if you got $30,000 from them and you have the money, lender's going to say you don't actually have $30,000 that's truly your dollars. We're going to give you $30,000 less in mortgage. You got to make up for that with $30,000 of legitimate down payment, which is again from your own sources or your direct family. So many people I've talked to have fallen short with that, and it sets you back at least 6 months. Next invalid source of down payment, debt. Debt could be you having an invalid gift payment, which is really debt, but also what if you borrow from the line of credit and you put it towards your down payment? There's about one lender that can allow that to happen given certain stipulations on, again, your debt to income ratios, how they balance out your mortgage power. Most of them say absolutely not to that because you're basically using debt to acquire more debt, which is the mortgage. Those are usually not allowed. Now, can you use a home equity line of credit from, let's say, another property? That's a bit more acceptable. But there's nuance on what debt you can accept. So when in doubt, talk to me. Okay? Super important things. Now, lastly, on the way that you get debt, when you're saving for a down payment, you got to make sure that you also cover the closing costs. And we'll talk about that in the next section here. You need to cover appraisal, property transfer tax, and we'll go through a whole list of those things. But if the lender sees that you have your down payment covered, but they don't see you've got legitimate money for your closing costs, again, a gift is not going to be enough, they won't advance the funds. Also, a lot of lenders, once they go through your file and let's say they disqualify you on a lower credit score, or they don't like something in your credit score, or your income is not as high as they would like it to be, you might need more down payment and more funds to show. So therefore, you got to have extra buffer reserves because things can happen with the lender, but also things can happen after you move into the property, renovations, repairs, furniture, you name it. So there's a lot of variables here where, again, you've got to have this liquidity and extra funds, both in the lender's eyes, but also practically speaking for you, because contingencies do happen. All these things you got to plan at least 6 months in advance and put onto a spreadsheet. To conclude, so many of these mess ups are avoidable if you stop assuming the lender thinks like you and you learn the rules of the game. Again, we talked about credit score, we talked about income and down payment, and of course, closing costs. All of those things, you got to be aware of what they are, and also beneath the surface, what is the fine print. And again, these things can take 6 to 12 plus months to course correct in the eyes of the lender. So do not procrastinate on this and do it last minute and assume it's okay, because you will be very frustrated. Talk to a broker, lay out a plan. It does not take long, and save yourself some stress. And I know we like to all leave things last minute, cram for exams, last minute packing, but for a home, please realize you cannot cram for the game of life and buying a home. I hope this helps, and I will see you in our first meeting.